Good morning and welcome to the Killik & Co Market Update. Over the past week, the major political event was the presidential inauguration and the associated shift in policy. Donald Trump was sworn in as the 47th US president in a ceremony on Monday. Trump is one of only two presidents who have won a second term after losing the previous election. It's widely expected that Trump's policies will resemble the America First agenda characteristic of his first term. In his first acts as a US president, Trump signed a series of executive orders, many of which have stoked controversy. Trump has also revoked a large number of the executive orders issued by former President Biden. An executive order is a legally binding written instruction which can only be issued by the president. It's enshrined within the US Constitution and enables the president to shape the policy agenda without approval from US politicians, although the orders can be challenged in Congress and the courts. Trump is considered to be one of the most unpredictable leaders, and investors have been trying to gauge the path ahead for trade policy. Following the election in November, Trump has made a series of statements suggesting that he'll impose tariffs on Canada, Mexico, the European Union and China. The uncertainty surrounding tariffs has contributed to a materially stronger dollar, as you can see in this chart. Tariffs are generally imposed to protect critical industries, to influence the policy of other governments, or as a tactic to bring other nations to the negotiating table. In the past week, Trump has threatened to impose tariffs of up to 25% on Mexico and Canada as early as February the 1st. Around 15% of all US imports are received from Mexico, and nearly 14% of imports are obtained from Canada. Trump has also threatened to impose tariffs on the European Union, while stating that the bloc needs to purchase more American oil and gas. He's threatened to intensify sanctions on Russia if they don't negotiate an end to the war in Ukraine. And after the delay of the ban of the online video platform TikTok, Trump has threatened to impose tariffs on China if the parent company do not sell a large stake to a US company. Tariffs are expected to lead to higher costs as companies pass on import duties to consumers. This has led to concerns that higher inflation will materialise, and markets have forecasted that interest rates will remain higher for longer. US government bond yields, which measure the rate of interest that the US government pays to lenders, have materially increased in recent months, as you can see in this chart. Earlier in the week, UK employment and wage data was released. The data showed that employers cut staff numbers after the budget and wage growth has accelerated. The number of payroll employees is estimated to have fallen by 47,000 in the 12 months of December, and the unemployment rate rose modestly. Sterling initially weakened on the back of the news, but has since recovered the losses. In contrast, wage growth surprised the upside and accelerated at an annualised rate of 5.6% compared with the same period in the previous year, beating consensus forecasts. Markets currently forecast that the Bank of England will cut interest rates by a quarter point when the committee convenes next month, from the current 4.75% benchmark rate. Moving to corporate earnings, Netflix reported a very strong set of fourth quarter results on Tuesday. The company announced that revenues increased by 16% and profits more than doubled when compared with the previous year. The company surpassed 300 million paid subscribers during the quarter, adding a record 19 million over the reporting period. The company has attributed the success to the continued investment in content creation and inroads into live sporting events. The shares reacted very favourably to the results. Intuitive Surgical reported results last night. The company is a pioneer and market leader in robot-assisted surgery. Fourth quarter results were ahead of expectations, with revenue surging 25% year over year and profits materially higher than expected. Intuitive manufacture robots used by medical professionals in minimally invasive care procedures in a broad range of surgical operations. The core product is called Da Vinci. There are over 8,000 robotic systems used in hospitals in over 70 countries, including the National Health Service. There have now been over 40 million robotic procedures, which generally result in shorter operating times, fewer complications, reduced pain for the patients and faster recovery periods. Intuitive recently launched its 5th generation robot, which has processing power 10,000 times out of the previous model and has greater capabilities in guiding doctors on procedural risks, which should ultimately reduce errors. There should also be continuous improvement in medical operations as the company embeds machine learning into its technology, harnessing real-time artificial intelligence to help surgeons predict patients' risk of complications. It's a busy schedule of earnings next week, with two of Europe's largest companies, LVMH and SAP, reporting on Tuesday. Technology companies, which led the US markets higher in 2024, will start reporting next week, with Meta and Microsoft on Wednesday, Apple on Thursday, and then Amazon on Friday. That's all from us this week. If you have any questions or comments on today's update, please do get in touch with us by contacting info@killik.com. Have a great weekend, and we'll see you next week.